Why do people save money with whole life insurance? First, I'll let you know what they don't do. They don't save a lot of money in a life insurance policy for the life insurance benefit. It's very common to hear from almost everyone that we work with, I don't care about the death benefit at all. I'm interested in saving money in this whole life insurance policy because of the cash value. That is the main area of attraction. Here's why. So when I look at the cash value, the first point of attraction is that it is a safe place to put money, meaning there's no risk, regardless of what happens in the economy, the stock market. Things are going crazy around us. We know that the cash value in a whole life insurance policy will just continue to appreciate over time. Number two, it's very easy to access my cash value. I can typically access it within 2 to 3 business days, meaning when I request funds, they hit my bank account by means of direct deposit within 2 or 3 days. It's very fast. And it works a lot like a line of credit or a home equity loan. So for example, if I own a home and it's worth $100,000 and we'll pretend that it's appreciating by 5% every year, the fair market value, if you own it free and clear, what's the value after 1 year? Was $100,000, you earned 5%, now it's $105,000. Let's pretend you take a loan against it, a home equity loan. So we'll go back to when it's worth $100,000. You loan $50,000. So you take a $50,000 loan. You've got interest that's due on that $50,000. Where does that go? To the bank or lender. Now the 5% appreciation you were receiving on your home, do you get that on the entire home value or only what's left in equity? You get it on the entire home value. So how that's like a life insurance policy is if you have $100,000 in cash value, pretend it's earning 5%, if you loan $50,000, you've got $50,000 remaining in equity, another $50,000 you can borrow. However, you still get that 5% depreciation or whatever the growth rate is on the full $100,000. So there's no lost opportunity cost. My money keeps on compounding. We do want to account for the cost to borrow, the loan interest that goes to the insurance company. But when I look at the numbers, generally it makes sense. We always want to look at the numbers, but usually it's a very attractive place to put money for this reason. We'll see a lot of real estate investors and business owners put a lot of money into cash value life insurance. And the main reason why, like what they're doing is just building up a big bucket of cash value that they can access very quickly and easily for opportunities for their business. And they know if and when they pay it back, their cash value is restored to what it would have been. So the money keeps on moving forward, and it's this big line of credit that they have access to. They don't have to deal with banks, institutions, paperwork, none of that stuff. It lets them move fast, which is very important if you're in business. You know that. So that's the second reason. It's very easy to access the funds. And then the third reason is that it's tax-free. If you do everything right, because it is possible to trigger a taxable event in a life insurance policy, as long as your agent makes sure that that does not happen, you can access the cash value tax-free anytime. And this has always been a main driver of interest with whole life insurance, especially if I'm in a higher tax bracket, because I don't have to worry about tax brackets going up or anything like that. This money continues to appreciate, it grows tax deferred, and when I access it, it can all be tax-free. It's a very attractive asset for that reason. So the tax benefits are huge. So those are the main 3 reasons why people typically save money in whole life insurance. Now with that said, if you've ever seen a whole life insurance policy and looked at the cash value and said, why would anyone do this? Because the cash value looks ugly in the beginning. I'm talking I've got 0 of my payment in cash value, or I only see 50 or 60% of my payment in cash value, and it takes me like 10 years to get my money back. I wouldn't do it. I would not even come close to doing that. If you saw a whole life insurance policy that looked like that, that means the insurance expenses were too high. You see, when you set up a whole life insurance policy, we can set the insurance expenses almost wherever we want. There are minimums, and the name of the game is really just reducing the minimum insurance expense, the premium, as low as the insurance company will allow. And a quick way to tell if the insurance expenses are truly at the minimum is when you pay money in, how much of that cash value is available in the first year. If you pay $10,000, to use a simple number, if you have zero in cash value in the first year, that means all of your payment went toward the insurance expense. If you have $5,000 in cash value in the first year, where you paid $10K, that means 50% of your payment went toward the insurance expense or the premium. If you have between 80 and 90%, so $8,000 and $9,000 in cash value in the first year, that means the insurance expenses are likely at the minimum. The minimum with a lot of the top companies is often right around 10%. So if I'm paying $10,000, my minimum premium is about $1,000. So we do want to make sure that the policy is set up with minimum expenses and maximum cash value, because if you do that, when you're saving money with whole life insurance, minimum expenses are going to result in the most cash value upfront and often in the most cash value long term. But really, when I see that value upfront, I get my money back quickly. What you're doing is copying what wealthy individuals and corporations do with these products, where you hear stories of them putting away boatloads of cash into these policies, which they do, but the emphasis is on cash value and maximizing that from the get-go. So I hope that this video was helpful. If you'd like to learn more about how to maximize the cash value in a whole life insurance policy, I would check out this video here.